Good morning, traders. Gold has now reacted to the geopolitical escalation, and the real question today is no longer is gold bullish? The question is gold building acceptance at higher prices, or are we setting up for a deeper liquidity retracement before continuation? When markets expand aggressively, the next phase is either acceptance and continuation or rebalance and retracement. Today is about reading that shift correctly. Let's break this down step by step using our full framework. First, mark the previous day high and the previous day low. We've marked the previous day low at 5260.2 and the previous day high at 5420.426. This defines yesterday's dealing range. Why does this matter? Because price moves from liquidity to liquidity. Above the PDH lies buy stops, breakout traders and momentum entries, and below the PDL lies sell stops, late sellers and weak longs exiting. If we are trading above PDH today, that suggests expansion. If you're trading back inside yesterday's range, that signals possible rebalancing. If we sweep PDH and fail to continue, that could mark temporary exhaustion. PDH and PDL are not just lines, they tell us whether we are in expansion or rotation. Step 2. Now zoom out of the daily time frame, and after a strong movement driven by macro tensions, check for new fair value gaps, large displacement candles and delivery voids. We can see that there is a delivery void over here from yesterday's candle, and we will now mark that. This spans from 5322.5 to 5273.1. When gold moves aggressively, it leaves inefficiencies behind, and markets don't like inefficiencies long term. They rebalance. If a new daily fair value gap formed yesterday, that becomes a reference point for the rest of the week, considering it was Monday. If price is trading far above the imbalance without retracing, odds increase that at some point we will rebalance a part of it. So the important principle is strong bullish bias does not eliminate retracement possibility. It just changes how we trade the retracement. We now move on to 4-hour, and we can see that yesterday's 4-hour candle left an inefficiency over here. We will mark this as a 1-day void, while this is a 4-hour sell side imbalance called a SIBI. This on the 4-hour candle and the 4-hour time frame is where the institutional footprints are clearer. Mark any unmitigated 4-hour fair value gap formed yesterday. These areas represent aggressive repricing, institutional activity and incomplete delivery. If price retraces into a 4-hour SIBI and shows displacement upwards, that becomes a continuation opportunity. If it slices through multiple 4-hour imbalances without reaction, that signals potential shift. 4-hour imbalance is where London or New York will engineer a retracement before expansion. We now move on to the 1-hour, where we mark any buy side liquidity which the previous day high already marks, and this we can consider this as a 1-hour buy side liquidity. Here we look for, has price left any equal lows below current structure? If yes, there's a potential sweep target before continuation. We don't see that here. Has price left any equal highs? Yes, there's an equal high here. Then this becomes the upside objective. The key rule is liquidity sweep without displacement becomes a manipulation, while liquidity sweeps with displacement could mean expansion, which means if the market comes to this level, sweeps this liquidity and moves back, that means it could be a retracement, while if it solidly closes above this level, it could mean an expansion. If London sweeps sell side liquidity and then displaces strongly upwards, that confirms a bullish continuation. If we sweep buy side and stall, that suggests a temporary exhaustion. Here also consider that it made a void as today's day opened. So we can mark the 1-hour void here, which the market has already tapped into. The next important aspect is the previous day volume profile. So let us now use the fixed range volume profile to mark the start of yesterday, which was at 1800 hours of New York, and we add a current FRVP here. So we can see that the market is being supported at this level. Let us first, this is the current day FRVP. Let us first consider the previous day's FRVP, which started on the 1st of March and it ended at 1600 hours. So this will give you the previous day's levels. So we mark the value area high, which is this. We then mark this level, the POC, at 5331.6. POC is the value at which there was maximum volume, which means in this case is 5331.6. And we mark yesterday's value area low. So POC, like I mentioned, is where most business occurred yesterday, which is at 5331.6. This is a fair value, what was considered fair value in yesterday's trading day. If the price is trading and accepting above the VAH, that means the market is comfortable building value higher. So if the market closes above this and holds, it means that the market can continue upward. If the price falls back into value and rotates around the POC, the signal is that it's rebalancing. If we break below the value area low, the VAL, and accept below, that changes short-term structure. Volume tells us whether the market agrees with yesterday's move. Outside the value, these two in this case, means expansion, and inside value means digestion. We now use the fib to mark the equilibrium level of yesterday's range. The market always moves back to rebalance at certain levels, and 0.5 is half of yesterday's range, which means more often than not the market does come back to this level. So we mark it as 0.5 previous day. So 50%, as I mentioned, is equilibrium. Above 50% is premium, and below 50% is discount. Institutions sell in a premium and buy in discount. If price retraces into discount and shows displacement upwards, that defines a continuation. Let's say we come back here and hold price, the market could continue upward, and vice versa. Equilibrium helps us measure risk. If price stays extended in premium without retracing, risk increases for a sharper pullback. So if you're very far away from the 0.5 of the previous day, be cautious. Buying far above equilibrium increases risk. Buying near discount improves risk to reward. We now go on to psychological levels. Gold respects round numbers heavily. Whole numbers act as liquidity magnets. Traders cluster stops around them. If we approach a major psychological level, expect volatility, stop runs, reaction. These levels often align with liquidity sweeps. Do not ignore round numbers, especially after a strong expansion day. So the previous day's value area high is around 5,400. So this will be an important level. The previous day's 0.5 is at 5350, around a whole number 5350, where you also see that there is a 1 hour void and a 4 RCB ending. So now let us come to our bias and scenario planning. Macro backdrop remains supportive for bullish, for the price to hold above and expand above. But structurally, today is about whether gold accepts yesterday's highs and continues higher, or sweeps liquidity and retraces into imbalances before continuing. In this case, it would mean, will price move up, or will it come back to retrace into these inefficiencies and then react? Scenario A is a bullish continuation. It holds above PDH. Acceptance, or there's acceptance above the previous day's high, value area high. There's no strong rejection wicks. Displacement after minor retracement. That targets higher liquidities, and in this case around 5420. These are the highs that it can target. And the scenario B is liquidity retrace first. So it sweeps a buy side liquidity, stalls in premium, and retraces into 4-hour imbalance or a discount zone. And it then displaces upward. That becomes the better structured entry, and in this case for the market to come back here and react at these levels, about 5350. We do not guess, we react to displacement. So today is not about predicting, it's about reading delivery. Gold has expanded yesterday. Now we observe, is the market comfortable here or does it need to rebalance first? Mark your liquidities, mark your imbalances, mark equilibrium, and respect psychological levels. Let prices show its hand, stay disciplined, trade structure, avoid emotional entries. I'll update after London. Trade smart.